Good evening, everyone. Thanks for this opportunity, to address you all. So, as you know, this year we started off this year itself, with some amount of volatility and a bit of kind of a nervousness, in the global markets, primarily because, as you know, that globally we are seeing now the whole liquidity rally, which drove the markets in the last 2 years, that is slowly getting withdrawn now. So we've seen interest rates. Fed announcing sharper rate hikes, inflation kind of in US really at a 20-year high. So all these factors have led to a kind of a weak start to the market in this calendar year. And our belief was that this year the markets will probably do more of consolidation. The returns in the markets would be probably muted, say around 10% or so. And this year we will see some normalization of the high valuations which were there in the market, right? We've seen because of the easy liquidity and the low interest rates, the valuations across the stocks and across the broader market had also really gone up. So that normalization was expected to happen in this year. So that was what we started off the year. But then subsequently, and we've seen even before this thing broke out last 5 to 6 months, FIs have been big sellers in the markets. They have sold almost like $12 billion in the last 6 months, which has been the highest selling which you have seen after the global financial crisis after 2008. So amidst this backdrop, our market was holding on fairly well. If you look at the domestic market, we had seen some correction, but not really much, not in double-digit kind of a correction. But when this crisis broke out, right, the Russia, when the crisis was simmering, we saw that oil also started to move up, right? Oil, which was around $80, $75, $80, went into the 90s. And that was some cause of worry for India because, as you know, India still imports a lot of oil and that impacts our current account deficit. But we are still holding on. But after the crisis in Ukraine escalated and Russia kind of invaded Ukraine, we saw there was a risk off globally and correction across the global markets, anywhere around 4 to 5% or so. And that has really broken the overall short-term trend of the market, which was there. The market was holding on fairly well. But the key now question is that what happens now, right? Does it really is a real cause of concern and we are going to get into a bear market at this point in time? Or it is just a kind of a correction in a broader long-term bull market for our markets? So I think just to understand, I think the Russia invasion into Ukraine has meant that US has now imposed sanctions on Russia. And as you know, Russia is a large exporter of commodities, especially oil, gas, certain metals like steel, aluminium, and also certain rare metals. So imposing sanctions on Russia would mean that the prices of some of the commodities, and even for that matter, food grain prices. Russia is also a large exporter of wheat and barley and some of the other food items, not Russia, but even Ukraine, I would say. And that would mean that inflation even in food prices. So that is one cause of worry. And also the fact that it could impact some bit of global growth, because whenever there are sanctions and other things, we see the global trade gets impacted. So those are the concerns, and whether this could further escalate and lead to a full-blown kind of a skirmish. So all these pieces of the markets really reacting to that. My view is that globally, whenever such events happens, any geopolitical instability or a war-like situation, the markets tends to react immediately, trying to overestimate the impact of the risk on the economy. And we see a knee-jerk reaction, a correction in the market. But subsequently, in the next 6 months, if you've seen last 7, 8 instances, when such events have happened in the last 30 years, markets have actually given positive returns and decent positive returns, in the next 6 months or so. I don't see any change to that. I would say that this is also an event, which has probably accentuated the much needed correction in the market, which was needed. we had seen in the last 2 years after the COVID crisis, the markets had been on a 1 year, on a kind of a one-way journey up without any meaningful corrections. At best, we had seen around 8 to 10% correction. And a deeper correction was necessary, which has happened after this event. And I think that correction is very important for the markets to really shake out some weak players. And if it has to really make up at a new high, then this correction was quite necessary. And the events which unfolded in the last few days have led to that. I'm not only in India, but also across the globe. No doubt, there are some negatives, on the horizon. Oil prices would still remain elevated at around $100 or so, which is kind of still manageable for us. While it puts some pressure on the current account deficit, it puts some pressure on the rupee. But fortunately, in India, we've got very strong forex reserves. We have built this reserve over the last few years because of the strong inflows, what we've seen from FDI, which is foreign direct investment, and FII flows. And we're sitting on almost like $600 billion or more of forex reserves, which gives us some cushion and breathing space for the government and for the RBI to not panic and increase interest rates, right? RBI, as you know, has been keeping the interest rates still. The policy environment is still fairly accommodative. They have kept interest rates still low. And further, RBI is able to manage the rupee also much better. So don't see immediate challenges for India. We're in a fairly comfortable situation. It does put some kind of a cap to the market from a near-term perspective because of these headwinds which have come up. But overall, I think the growth trajectory or the recovery in India, what we are seeing now, the post the pandemic, I think we are slowly and steadily getting into that pace. I don't see that trajectory really changing in a big way for India. And to that extent, I think the markets probably it might come down further from these levels. You might see a further downside, which is quite natural. But I don't see it really staying low for a long period of time. I think as we move forward, as the recovery in India slowly gains momentum, as the earnings growth of companies also slowly and steadily improves, markets will continue to move higher. But from a very near-term perspective, I think until this uncertainty and this kind of the markets might remain a bit range-bound. You could probably see some more, one more knee-jerk reaction in the market, depending on how the situation develops on the Ukraine and Russia front. But I think I clearly believe that this is an opportunity really to buy. If you look at the market, is now at a very fair zone. Right? The market was probably a tad expensive. When we had seen the rally in the market in the last 1 or 2 years, but now with this correction, the market's P multiple, the valuation is somewhere near the long-term average. It's not expensive. There could be undershoot on the downside, which can happen. Which quite possible, but otherwise the markets are fairly priced, and one can get fairly reasonable returns. I won't say you will get very high returns from here, because the multiples are not as cheap as one would have liked it to be, but still a reasonably good return over the medium to long term, as we see fairly strong corporate earnings recovery over the next 3 years or so. We expect a double-digit growth in earnings for the Nifty companies over the next 3 years. And with market P multiple also at the average levels, I think market returns should also be somewhere around 10 to 12% over the next, say, 3-year time frame is what one can expect, which is a reasonably good returns looking at where interest rates are at this point in time. So I would say don't go aggressive at this point in time in the market, but clearly buy and steadily keep on making the investments. If there is any correction in the market further, I think one can be more aggressive in terms of deploying money into the markets. And I think even a correction happen, even if there's a 10% correction from here, in the market, the overall trajectory of the market, right, or the overall trend in the market, which is still kind of up, I would say, we are still in a kind of a bullish market, I think that doesn't really change. So that's the broad outlook, which I thought let me share with you just as a backdrop before we actually open up into further Q&A. Yeah, so as I mentioned, one is on the valuations. So valuations were expensive. Market was always expensive in the last couple of years because the market was slightly going ahead of the fundamentals. And because of the large liquidity-driven rally, there was a lot of money which was chasing the market. But earnings growth has also caught up fairly well in the last, in FY21 and FY22. In fact, in FY21, despite the COVID crisis and the GDP growth was negative, actually, right? We had almost minus 9% GDP growth. Actually, Nifty earnings showed a positive growth, a mild or positive growth. And this year also, we are seeing almost like a 25 to 30% growth for Nifty companies. So I think a lot of corporate India has actually done well, despite the economic growth is still weak. On the back of better productivity, efficiency gains, companies have reduced their debt, interest rate cost has gone down. So a lot of sectors are starting to look up now, be the commodity sector, the banking and financial services sector, which went through a pain 2 years back. That is also coming up. So I think the earnings growth for companies going forward, even in FY23 and FY24 should be in double digits is what we would think. There has been some disappointment in earnings in this last quarter because of margin pressure. Commodity prices have gone up and that has exerted pressure on the margins for a few companies. And the recovery in rural India has been a bit slower. But by and large, I'm not seeing any major downgrades to earnings. So we could expect a double-digit earnings growth, say in the low teens over the next 3 years. And valuation multiple, like P multiple, as I said, is near the long-term average, a tad above that. The price to value multiple probably slightly expensive. So in that scenario, I think one should expect the market returns also probably to track earnings growth. Or probably there could be some normalization of P multiples, because normally as interest rates go up and we're expecting rates to go up globally as well as in India, the P multiples would probably get normalized a bit. There could be some multiples in these few sectors where the multiples are still much higher, valuations are much higher than the long-term averages. I think we will see that normalizing, and we've seen that play out actually in a few sectors, especially sectors, the high growth sectors, the high quality sectors. The multiples have really come down quite decently in the last couple of months. And globally, as you know, NASDAQ, which is a kind of a market which resembles the technology companies and also the new age technology companies, so these stocks have seen a big correction because their multiples, the valuations was much higher. We've seen all these stocks do well over the last 3-4 years. And now with interest rates going up, the valuations have started to correct a bit. Yeah, so I think, see, the small cap and mid cap space has had a very good run in the last 2 years, right? We've seen on the back of the revival, in the various sectors. And the liquidity also. We've seen a lot of retail money has come into the market in the last couple of years, especially post-COVID. And that has also helped the small cap and mid cap space really do very well. And I think, see, whenever there is a risk off in the market, right? And normally the mid caps and small caps tend to fall more. But we have seen the mid cap, only in the last 1 month, we have seen some major correction in the small caps and the mid cap stocks. Otherwise, they have been doing fairly well because the domestic money was still pouring into the markets, right? So the domestic money into the markets was still pouring in. Now, I think now with the risk slightly going up in the market, volatility increasing, the mid cap and small cap could probably face some challenge from a short-term perspective. You could, if there is a further correction, if there is, global geopolitical tensions further escalate, then small caps can see more correction from here. Typically, that's what happens. Okay, when there is a risk off scenario, as I mentioned, but I think overall, I think from a slightly medium term perspective or say next 3 year perspective, I think small caps can still do well, reasonably well, because most of the small cap companies are linked to the domestic economy, right? India's growth is slowly recovering, and we expect India's growth to recover in the next one year or so back to the pre-COVID level. And in fact, we would expect India's GDP growth to probably be near around 6.5%, which is the long-term trend line growth. And in that situation, I think the mid caps, small caps companies, their earnings growth can do well. So, barring near-term volatility and some further downside, if at all the market's correct, I think small cap should still be okay. But let me caution here on the small cap space is that there is a lot of, because of the brute money power in the last 1 year, a lot of small cap companies have gone up. But I think as the liquidity overall globally is slowly getting withdrawn, you will see that only the good companies in the small cap space or the mid cap space, fundamentally sound companies will only do well. The froth which was there in the market, I think that is likely to go away. So one needs to be cautious over there because many companies have really shot up without actually fundamentals, purely on the basis of liquidity and money power. That could probably start to wane off. Okay, and the retail money which has come in is also probably, if they see some more correction, I think that there could be some shakeout there, because a lot of new retail investors who have come in, especially the new millennials who have come in the last couple of years, haven't seen a major correction in the market. And this is a time, okay, where they would be tested. How much they really stay put in the market or whether they panic can lead to a kind of a knee-jerk reaction, okay, or a deeper correction in the small cap space from a short-term perspective. But as a long-term investor, I think small cap space should do well. I think, I mean, it could be an opportunity, in fact, if there is a correction in good quality small cap stocks. No, I think markets, while there are, it's not going to be a one-way rally, right? What we saw earlier. There are some risks which are there in the market around the horizon. So it's not hunky-dory in the market. But at the same time, I think that overall trajectory of the market and the Indian economy is only likely to improve from here. I mean, Indian economy, we've seen multiple. So given that, Indian market should do reasonably well. And over the next 2 years, or with a 2 year, 3 year horizon, I think one can expect reasonable returns from the market. When I say reasonable, means just enough to take care of the volatility and risk associated with the markets. So, I mean, it could be anywhere between, say low teens kind of a return, which is still good compared to what you would get in, say, other asset class like debt. There will be more volatility, which would be there. So I would suggest that they should look at a large cap fund, okay, because there has been a decent correction in the large cap stocks, and that provides a lot of stability and not stability, I would say, but these are well-established companies. Okay, they are much more resilient, and as the markets move up, I think the large cap space should also do well. The balance advantage category can also be, if you're slightly worried about the volatility investor, then they can look at the balance advantage category where the allocation in the market varies, equity allocation depending on the market. And as the market's correct, the equity allocation can go up or down. But at this juncture, now today, I would say that if you have to invest that money, I would not advise a lump sum investment, because we are in the midst of some kind of a period where the market is probably in a correction phase, a short-term correction though, and it will be better to kind of spread it out and do that, and probably go aggressive. Okay, if there is a correction in the market, say any 5 to 10% correction in the market, one can go aggressive. If you're investing in a balanced advantage fund kind of a fund, then probably one can be more aggressive and do a lump sum investment, because there normally the allocation in equity at this point in time would be lower. Like, for example, in our balance advantage fund, currently we are running around 45% equity exposure, 46%. And as the markets correct, we'll increase that much higher. So in those kind of funds, probably one can still do a lump sum investments. But otherwise, I would say a staggered investment would be a better idea. So, I mean, I would not say that the worst is over. You never know how these war situations tend to escalate and where it goes, right? But it looks like for the time being, I think the sanctions what US has imposed on Russia, they have excluded, say, for example, oil and gas and other sectors, okay, which Russia is a large exporter over there. And Russia also probably would not want to because the economy is also now coming under pressure. So beyond a point, they will not stretch it. So, but these things are very difficult to predict. So I would not say this is the end of it. That's why I'm saying we should be prepared that there could be some more downside here in the markets as situation escalates. But again, the previous experience is that even if there is a correction in the market, other things being equal, and this thing you should bounce back. And normally the situations don't last for too long, is what my experience is. So that's how I would look at it. In terms of sectors which get impacted because of the geopolitical issues which have cropped up and sanctions are, I mean, India is not directly impacted as such. We are pretty well covered. I mean, obviously, it has increased the energy basket, right? The prices of oil, gas, and some of the commodities, metals has gone up. So obviously, sectors which are more dependent on oil derivatives as an input cost will see some margin pressure. We have seen companies reeling under the pressure of higher commodity inflation over the last 6 months, and this puts further pressure on that. So any sector, okay, which is a large input of oil derivatives or chemicals and petrochemicals, I think they would see some margin pressure. I mean, that's I think the only impact I see as a fallout of this. We are also some exports to Russia which are there, right? There are a few companies, not many, but say pharmaceuticals, few companies have got exposure to Russia. So because of the Russian ruble, which has also depreciated, there could be impact on revenues over there. So a few pharma companies have got some exposure, so there would probably be some adverse impact over there. Apart from that, I don't see any major impact for our companies, any major sector which I foresee. Yeah, so I think the gold has kind of seen some traction recently. Again, gold hadn't done much really in the last 6 months, though one would have expected in a period where inflationary pressures are starting to build up, right? And gold normally does well in that kind of an environment, but there are other factors, okay, which drive gold demand and prices over there. But now I think the situation with risks across asset class going up and inflationary pressures further kind of heightened because of the increase in the the Russia invasion to Ukraine. I would say gold looks to be slightly better at this point over there, risk reward, and one can make an allocation to gold. Probably, I mean, I don't know what kind of a return you could make, but clearly it looks like gold should give you, looking at the fact that it's underperformed and the current macro situation, okay, which is unfolding with more uncertainty, gold can be a safe haven and could see the demand going up and prices also moving up. So I would say definitely gold should be looked at as an asset class. Again, it depends on how much you want to invest in gold. Normally, if we would recommend, say, around 10 to 15%, 10 to 15% in gold and silver. I think if you stick to that allocation, I think that should be fine. I think it should do reasonably well. Even silver, for that matter, also looks good, because across the board we've seen commodity prices. These are precious commodities. prices have gone. Again, silver is also a derivative of demand is derived on the pickup in industrial activity, right, and global growth. And global growth is picking up a lot of industrial activities, because especially in the US and developed markets, I think there is a stimulus, okay, which has been given, and we see that in the numbers also, the PMI indices and this thing are showing up. So silver, demand for silver, from the commercial side, industrial side, is also likely to move up. So given that, I think the outlook there looks fairly decent, both for gold and silver. And yeah, definitely, I think it should be looked at as an asset class to invest, say with a 1 year view. Actually started correcting much earlier, right? That was mainly on the back of US Fed increasing interest rate, trying to turn more hawkish, and a lot of the companies, NASDAQ, are more technology oriented, high growth companies. Some of these are the new age technology companies which are not profit making, and these have seen a very sharp correction. The stocks have corrected. Some of these new age technology stocks, non-profit making technology companies, high growth companies, have corrected almost 50, 60, 70% also. And NASDAQ itself has seen a correction of almost like 22, 23, 22% from its peak. That's a fairly good correction, which is, and I would say a lot of the large companies in the NASDAQ are good companies. When, I mean, whether it is the Amazons of the world, Microsofts of the world, right, and Apple's. So I think the post the correction, I think they are now looking much more reasonable, and I think overall growth outlook there for some of the technology names is still fairly decent, right? I mean, there has been some slowdown. We saw that because during the pandemic there was a big buoyancy, okay, for growth that is kind of normalizing a bit, but otherwise I don't see much of a challenge. So I think, yeah, NASDAQ post this correction looks to be a good alternative to look at, right? Obviously, it will be a bit more volatile, and that one should keep in mind. But I think the valuations now, especially for the large names, right? At least the top 6, 7 companies, which are a large part of the index, are looking much more reasonable, and these are solid companies, right? With a solid future and pretty robust earnings. I mean, again, it depends on what you want to play, right? NASDAQ would be still more volatile, I would say, because markets are still trying to normalize. The multiples are still trying to normalize, okay? And so it will be a bit more volatile. So depending on the risk appetite, one can choose. If you've got a high risk appetite, you can look at NASDAQ. Otherwise, I think S&P 500, S&P would be the better index to really play the US markets.
I mean, suppose time horizon is like 7 to 10 years. So from growth point of view, which we can think is like will be better.
Again, I think, see, again, one would not want to put only on one. Like I said, NASDAQ has got its own kind of characteristics, right? More of the technology names, the new age companies, okay, which are there, which are high growth, and the way things are moving globally, moving towards digital and technology, I think that looks to be a good long-term story, but it has its bouts of volatility, which is there. So I would say keep a basket of both, right? NASDAQ as well as the S&P. Okay, if we can do that, I think that is what I would advise, rather than investing only in one. Normally, I think for the first time investor, I would say it's better to invest into a more diversified basket, right? Which is the S&P, which is much more diversified across sectors, rather than getting into the NASDAQ, which has got slightly more tilt towards the technology names. So I think for a normal investor, right, I think a 10 to 15% should be good enough, right? Because one should not go, I think that kind of a asset diversification within the equities, but across geography, I think that's good enough. For more evolved investors, people who kind of already have a sufficient exposure in India, probably they can look at slightly 5 to 10%, probably more if at all. But I think that's what I think. The going forward, the opportunity in India outlook is also looking good. I think for the first time, India is now coming out of its age, and we see fairly good prospects for Indian economy over the next 3 years. Global economy and global market, US has done well in the last decade or so, has outperformed, but going forward they'll still do okay, but probably not as well. And India looks to be fairly a better growth market over the next 5 years. So given that, I would say of 10 to 15% as a diversification would be, I think, ideal thing for a normal investor. Globally, we have seen growth which was there very strong post the pandemic. Probably you could see some slowdown of that because as the policymakers globally start to really unwind the liquidity, increase interest rates, which is probably much sharper than what you would see over here. So given that, I would say the returns there in the global markets, okay, don't go by the past returns, okay, what you see. But yeah, it would still be decent. I think the large economy like US and this thing are much more robust, and some of the companies are global companies. They're not dependent on one country or developed markets, right? And so that should still be fine. So I think you should go, but not very aggressive. And some of the global funds also allow you to really invest in sectors and this thing which you probably can't have much exposure in the Indian markets, right? So like whether it's the technology space, I'm not talking about the traditional IT services, but the new age technology, or even there's a lot of investing which is happening on the ESG side, right? Green technology. So if you're investing in some of these niche areas, then some of the global funds can be an option because we don't have much of companies really in those sectors. So we have been saying, we came with the annual outlook and we said that the sectors, okay, which we think will do well over the next 3 years, okay, the near future would be like banking, financial banking sector is looking fairly good. India is coming out from a phase where we saw large NPAs in the last 3-4 years. We're seeing that normalizing. Overall credit growth is also picking up slowly and steadily. And as Indian economic recovers, banking would do well. So that looks to be a good sector. I mean, we're positive on that. We are also positive on the whole industrials, and the investments in India are slowly starting to pick up, especially private sector capex. The government is also focusing on driving investments to boost the overall GDP growth, and companies like industrials, capital goods, the likes should do well. Real estate also is now coming out of a long cycle. A lot of things are in place for sector to do well with low interest rates, with demand slowly picking up, and and the whole boom in the IT sector is also driving prices for real estate in a few cities. So the real estate sector and the sectors linked to that, whether it's cement or home improvement, consumer durables, I think these are the sectors which look positive and where the growth momentum should be strong or improving in the next few years. So higher oil prices, again, you're right, it has an impact more on the CAD, I would say, the current account deficit, because your imports go up, Forex, there's a pressure. I mean, CAD balloons up negative, right? And that puts some pressure on the Forex reserve, on the rupee for that matter. Yeah, some impact on the fiscal side also a bit. But again, from the government perspective, it's inflationary, right? Government necessarily did not impact. The government duties, what the government collects on petrol and diesel, okay, that they continue to get. And I mean, only if they choose not to pass on the price increases, which they have done so. I mean, looking at the elections which are there in UP, the government hasn't increased petrol and diesel prices. To that extent, they has to bear their subsidy. Their subsidy has been probably borne by the companies, not by the government directly, right? The oil marketing companies, HP, BP, IOC are bearing that pain as of now, at least. But I think later on, they'll allow it to pass on that increase to the end consumer. So not such an impact on the fiscal deficit, I would say. But yeah, and again, it depends on how long this remains. But clearly, as oil prices go up, it is inflationary. It puts some impact on consumption because as inflation goes, the disposable income will go down, and that impacts growth a bit, and that impacts the revenue collection, tax revenue collections for the government. So to that extent, it can impact the fiscal side. So there is some impact, but okay, not such a direct impact as one would think. So I would say that for investors, I think we are in times where, as I said, there will be more volatility. There are headwinds which are there to the markets, which was not the case around 1 or 2 years back, right? So you have to choose. Okay, don't take unnecessary risk in the market. Invest wisely. Think slightly longer term. Don't overexpose yourself. At the same time, don't underinvest in the market. Nothing to be too worried about at this point in time. I mean, we have seen many such corrections in the past, many such events. Even in a bullish market, a correction in the market of around 20% is common. I mean, or more than say 10% is quite common. And one should actually use that opportunity to really any kind of a sharp correction in the market just because of some events. Should use the opportunity to actually invest more if you are underinvested, I would say, right? One should definitely do that and continue with your steady investments. I mean, regular disciplined investment in the market, and that should continue, and one should not stop that because of some headwinds which have come up into the market. If you do that, I think you should be fine. I think you should, and there is. I mean, I firmly believe that the markets are still in a journey, okay, which will continue to scale new highs in the coming year because overall economic growth and this thing is likely to improve, corporate earnings will likely to improve. So one needs to really get that, stay invested in the market, really to benefit out of that from a longer term perspective. So, and the market is going to be more discerning this time. So it will, I mean, it will evaluate risk and accordingly give the reward, which was not the case earlier. So if you're investing in the market directly also, be careful about that. Don't do rash investing because you might burn their fingers off, because we've seen now companies also correcting sharply wherever there are earnings disappointment or there are some fundamental issues. So one should be aware of those risks and accordingly makes one's investments. Otherwise, if you follow discipline, steadily investing in the market, I think the markets, even from here, will give you fairly decent returns over the medium to long term.
Great. I think there is one last question from Mr. Maheshwaran.
So FIs actually have been pulling out money, not now alone, but in the last 6 months, right? There's been a steady outflow, as I mentioned earlier. It has probably accelerated a bit whenever these events happen a bit. But despite that, the markets have been holding on fairly well, I would say, because domestic money has been coming in to offset that to some extent. I think looking at the sell-off, we have seen an extended period of sell-off now, right? We haven't seen such a large period, except probably after the global financial crisis or 2013, we saw some. So this is an extraordinary sell-off period, so that should abate a bit, I guess. I mean, in the current scenario, okay, when you see the geopolitical risk, probably it's a risk-off and money moves across asset classes, right? Risk asset class across the globe. So that situation still persists. So you might still continue to see this selling pertaining. And if the domestic inflows also kind of get slowed down because of people are seeing now some losses in their portfolio, yeah, that can further lead to more downside. But again, difficult to predict that to what extent. But my guess is that, I mean, once the situation normalizes a bit, I think FIs would look at India slightly more positively because India still remains a fairly decent growth market compared to what's happening around the world. And after the selling, what we've seen in the last 6 months, their positions will be much lower, right? So they're no longer as overweight as they were, say, around 6 to 9 months back. And traditionally, FIs have been always positive. I mean, FI flows have been always positive in any calendar year, except for one, which in the last 15 years, right? So, yeah. So given that, I mean, even if the flows are negative for a few months or so, I would say that again should come back. So, yeah. So I think in that event, I think, and looking at the current scenario, I think you're right. It will be better to stagger off to an STP or whatever for the next couple of months or next 2 to 3 months. I think that should be a right time frame because market is now in a correction phase, right? So probably, and these corrections happen very fast sometimes. Right? Markets can correct one day by 5-6% or 7%, probably bounce back. You will not be able to catch up. But yeah, I think the next 2 months, I think would be our ideal period to stagger it out. And if there is a deeper correction, one can probably upfront those investments. I think would be a good strategy to adopt in this situation. Yeah, so good question. So I think you should look at your age, okay, your risk appetite, right, to decide how much allocation you want to equity. I mean, your advisor will tell you that, right? What's a right equity, target equity allocation, and you measure from that. Say your target equity exposure allocation overall as a part of your total investments, okay, it comes to around 60%, right? That's the normalized. Then that's what you should keep as a reference point, and then decide, okay, whether I should be, if I'm over invested about that, then probably one needs to normalize. The market goes up, okay, valuations becomes more expensive. Then one can really bring it down again back to those levels. If you're below that, you should start investing. You should make a beginning somewhere, right? And even now is a good time to do that, right? Despite the uncertainty and this thing, the markets are at very reasonable levels, and you don't know where the bottom is. So that's how I would look at. Decide your target allocation first. What is it, depending on your age, depending on your risk profile, and your time horizon? How much time you more have to invest? That's a function of your age also, right? And that's how you should look at it. And when I say long-term, see in equities, normally, when I say long-term, means you should have typically, I would say a 5-year horizon, because that's the time when you will see some cycle, right? Actually, 5 also is a slightly shorter time frame because that's not a full cycle. The equity cycles or market economic cycles are probably, if you want to play the full cycle, it will probably be 7 years or so. But I think 5 years is a reasonably good time frame, long-term time frame to consider. Okay, when I say a long-term view to take on a market, say, I mean, minimum 3, I would say, but ideally, I would say 5-year and more should be your time horizon. And as you increase your time horizon, yeah, your time in the market, then the volatility doesn't really matter, right? Even if you invest in the market at the wrong time also, okay, when it is slightly expensive, okay, it kind of reduces the overall return, but the chances of probability of making negative returns, right, goes down dramatically as you increase your time horizon. And we all know long-term returns for equities are somewhere around 11-12% or so, right? Around 12% thereabouts. So you would probably come to that average over a longer term, say over a 10-year time frame is what one should be looking at. So I think that's how I think you should look at, both in terms of allocation, how much you should allocate, and in terms of the time horizon, okay, while investing into equities.